Good evening and welcome to today's session. We'll be looking at business valuation and then measures and acquisition. All right, so we are starting with the business valuation. Starting with the business valuation. This reference. All right, so what do we mean by business valuation or the valuation of a business? So it's basically valuing the shares of the company, right? You can be valuing shares in both public and then private companies. And the valuation is needed for several purposes, right? The valuation is needed for what? For several purposes. Valuing the shares of both private and public companies. And there is a reason for valuing these shares. So what are some of the reasons? Reasons for valuing of reasons for business valuation. It's a likely question. Reasons for business valuation. Why do we value a business? All right. So, what are some of the reasons why we value a business? Yes, any idea? Why do we value business? Wow. Does it mean you've not gotten to the topic? You've not gotten to this topic. Hello, I'm speaking with. Hello. Hey, so you don't know the reasons for valuing business. Okay, let me mention names. So when I mention your name, then you answer. Informa, why do we value business? Okay, Wendy, why do we value business? Wendy.
To make investment decisions.
To make what? Come again. I can hardly hear you.
Make investment decisions. Hello, please can you hear me?
Please. Hello. You are saying to make investment decision, right?
Decisions.
All right, Francisca. Reasons for valuing a business.
So please, for strategic planning.
What are the reasons for valuing a business? All right, so welcome once again. So we are starting with business valuation, and then measures and acquisition. So let's begin with the first part, which is the business valuation. And looking at the reasons for business valuation. Why do we value a business? For what purpose do we value a business? So yes, one, for measures purposes. Sometimes you want to merge with another company, right? So as a result of it, that you have to value your worth, right? Or you have to value the worth of the other company to know how much they are bringing on board, right? So for measures what purposes, right? Right, or we are saying for measures and then take over purposes, right? Measures or take over purposes, right? And then for liquidation purposes, sometimes when you are going to liquidate, you have to value the business, right? You have to value the business because you'll be selling the business to a third party. So you are going to liquidate. So you have to value the worth of the business so that you know how much you sell to the one acquiring the business, right? Then you can also say, why do you value a business? For taxation purposes. For taxation what purposes? You value the business to know how much tax you are supposed to pay, right? Know how much taxes you are supposed to pay. What else? And also when you are entering the stock exchange market, right? So when you are entering the stock market, so you are going to be listed on the stock exchange. When you are going to be listed on the what? Stock exchange, right? You would have to value your business, right? All right. So these are some of the reasons. There are many more reasons that you can add. There are many more reasons that you can add. But for now, this is what I can give. All right. So let's look at approaches to the valuation. Which methods do we use in our valuation of the business? So let us look at some three main approach. So the three main approaches to valuation. Approaches to valuation of a business, right? So there are three main. What are the three main that I'll talk of? I'll first of all talk so three main approaches What are the three main approaches? One, the asset-based method. The asset what? Based method. Right? The asset-based what? Method. So what is the asset-based method about? So the asset-based method is based on tangible assets owned by the company, right? So these are based on the tangible assets, based on tangible assets what owned by the what company. Tangible assets owned by the company. Here we look at the net assets, right? The net assets here refers to what is that? Okay, the net asset would also be one of the words approach or one of the types of the asset-based method, right? One of the types of the asset-based method. So let me ignore it for the meantime, because I'll be listing about 3 of them. So let me ignore that. So we have the asset-based method. Then we have secondly, we have the income or earnings. Income or earnings. Or earnings-based method. Income or earnings-based method. What is that one about? So that one looks at the returns earned by the company. So let's look at the returns. The returns earned. The returns earned by the company, right? What else? Then we can talk of what? The cash flow. The cash flow based, right? The cash flow based. So it's based on the cash flows of the company, right? It is based on the cash flows. It's based on the cash flows of the company, cash flows of the company, right? Cash flows of the company. Based on the cash flows of the company. All right. All right, so let's take them one by one. Let's take the asset-based method. The asset-based method. Under the asset-based method, we can talk of the net assets. So we can talk of the net assets, right? The net assets or the book value. The net asset or the book value, right? The net asset or the book value. Secondly, we can talk of the net realizable value. Net realizable value. What else? And then we can talk of the replacement cost. Can talk of the replacement cost, right? So what is the net asset based method basically about, right? So the net asset is, or the book value values according to the statement of the financial position of the firm. So this one, the whole thing is about the assets, right? So we deduct all the liabilities. So it's talking about using the statement of the financial position, right? Using the statement of financial position of the firm, and we are able to get our net assets. So we deduct all the liabilities. We deduct all the liabilities. So in fact, the asset-based method is basically to get the value of the company. Let me bring it down here. Use reference. So the value of the company. How do you get the value of the company? Using the asset-based method. Value of the company. The value of the company is the value of all the assets minus what? Minus the value of all the liabilities. Right. So the value of the company is the value of what? Of the asset minus the value of all the liabilities, right? And that is the net asset-based method. So the net assets method uses the book value, right? Uses the book value. The book value means it uses the figures as presented on the statement of financial position, right? It uses the figures as presented. These are the book values. The values that you are seeing here, they are the book values. They are the figures given in the statement of financial position or the financial statement, right? And these are the book values, right? Or you can use the net realizable value. What is the net realizable value? The net realizable value is actually the sale value. If you want to sell the asset, right? If you want to sell the asset, this is how much you'll be selling it. So using the sale value. What are the replacement value? The replacement cost also is like if you want to get it from the market today, how much are you getting it at? So the replacement, if you want to replace it today, how much are you getting it at? Or it's like in terms of, let's say, a non-current asset, let's say a building. If you are building from the scratch, how much will it cost you? So example, maybe from building. So building from the scratch, how much will it cost you? If you are building from the scratch, right? So the net book values, net asset or the book values, they are the figures as you see on the financial position. And then the replacement cost is when you want to sell it. And then the realizable value is when you want to sell it. And then a replacement cost is the building from the scratch. If you want to replace that particular asset, how much will it replace it, right? So these are the three under the asset-based method. Under the asset-based method, and we value the business by deducting all the liabilities from the from the assets, all the liabilities from the asset, right? Note that the liabilities also, preference shares are also considered as a liability, right? So preference shares are also included as part of liabilities, right? Preference shares are also considered because the preference share has a fixed interest rate. It has what a fixed interest rate. It is an interest-bearing item, right? So because of that, we also treat it as a liability. So this is how we value a business using the asset-based method. using the asset. So let's look at some of the advantages. What are some of the advantages of this method? What are some of the advantages using the asset-based method? Let's look at some of the examples. Examples are some of the advantages. Advantages of using the asset base. So what are some of the advantages? It is easy to what? To compute, right? Easy to calculate. Just deducting all your liabilities from your asset. That is it. It is easy to calculate. What else? It can help to set the minimum price in negotiation, right? It can help. It can help to set the minimum price in negotiation, right? And then it is straightforward. It is clear and then straightforward, right? Or we can say that it provides clear and straightforward measure, right? Measuring using the asset base is straightforward. There is no complexity in this, right? It provides clear and then straightforward measure. Easy to calculate. It helps to set the minimum price in negotiations, right? Let us look at some of the disadvantages. What are some of the disadvantages? We can talk of. So, because you are using the book value, some of the information may be outdated. Information, because they are using the historical costs, right? These are past costs, so they may be outdated. They may be what? Outdated. So information may be outdated. What else? And the asset approach also ignores intangible assets. Ignores what? Intangible what? Assets, right? Okay, so that is that. That is that. Now let's move on to the second method. The second method, which will be what? Which will be the income or earnings based method. So we have done with the assets base. We are moving on to the income or earning base. Right? So income or earning base. Right? All right. So under the income or the earnings base, we said it's based on the what? On the returns, right? Earned by the what? Company. Returns earned by the company. So that one too, we'll be talking of when we come to the income or the earning base, we'll be talking of using the PE ratio, right? Price earning ratio. method. The PE ratio method, right? And then we would be talking about the earnings yield method. Earnings yield what method? Right. So earnings yield method and then the PE ratio method. So let's look at the PE ratio, the price earning ratio method. The price earning ratio method. So what is the price earning ratio? So the PE ratio looks at the or the inputs for all listed what company. So these are the PE ratio. The PE ratio is the price earning, right? And these are quoted for all listed what companies. All listed companies have the PE ratio. All listed companies have what PE ratio. All listed companies have the PE ratio, price earning, right? Price earning. The shares that they have, right? The shares that they have on the stock exchange. Right? When you say listed company, I mean those that are on the stock exchange, right? On the stock exchange. So the price are quoted for the P ratio are basically for those that are listed on the stock exchange, right? So how do we get the P ratio? The P ratio. What's the formula for the P ratio? We have done that. P ratio is what? Is price earnings. So definitely that would be the market price per share all over what? All over the earnings per share, right? The market price per share all over what? Earnings per share. Looking at the formula, P is the price, market price over earnings, right? So in the same, if you want to make earnings the subject, I believe you have to just interchange this, right? Interchange. Also, if you want to make MPS the subject, that you are going to multiply this, right? You are going to multiply this. You are going to multiply what? This. So this is with respect to per share. In terms of using the totals, we can say the value of the equity. Value of what? Equity. All over the what? The total earnings. This is in terms of one. And this is if you want the total. So total value of equity and the earnings per share. This is total earnings, right? Total what? Earnings. How do we get the earnings? Earnings. The earnings is the profit after tax. So if you are giving profit before tax, you have to adjust it by deducting the tax from it. So you want the profit after tax minus any preference what? Shares. Minus any preference what? Shares. Minus any preference shares. All right. Minus any preference shares. So I said that the P ratio is for those listed on the stock exchange. But in a situation whereby you are computing the market price per share or the value of a non-listed company, how then do you get a P ratio? How then do you get a P ratio? So that the one that is on the stock exchange is highly regulated, right? And as a result of that, their price per share is correct, right? It's usually correct because they are listed and they're highly regulated. All like those that are not regulated don't even have the P ratio. So we assume that their P ratio will be lower than that of the the one listed. So always the one listed on the stock exchange has a higher P ratio than that of the one not listed on the what? Not listed on the stock exchange. Not listed on the stock exchange. Right. So then how do we get uh, the P ratio? Or how do we get the value of a share for a non-listed company? So value, how do you value the shares of a non-listed company? A company that is not listed, you want to value it. Those that are on the stock exchange, because they are in the stock exchange, it's easy to what? Value them. But what of those that are not on the stock exchange? How do you value them? So value of a share, that is with respect to a unquoted company, right? Unquoted, not quoted on the stock exchange. How do we get it? So that will be the earnings per share. I believe, oh, okay, let me even make it here. Let me write it here. The NPS is equal to what? PE ratio times the earnings per share. Right? If you want to get the value of the price per share, is what just making NPS the subject. So this one will multiply this, right? So you are getting this. So for a non-listed or unquoted company, how do you get it? It's EPS, which is the same as the EPS that you are seeing here, times the PE ratio. But we have to adjust the PE ratio. So here it is the estimated PE ratio. So let me say estimated PE ratio, which is adjusted. Estimated PE ratio using an adjusted PE multiple from a similar quoted company. From a similar quoted company. Let me make it big so that when we get here, we start projecting the question. From a similar quoted company. All right. So this is when you want it as in the per share, right? Per share. But if we want the value of the entity, the value of the company as a whole, then we are going to use the total earnings, right? So the total earnings, the total earnings times the suitable PE ratio, right? So how do we get a suitable? So you adjust the PE ratio of the listed company downwards, right? Some use 75%. So maybe you can use 75%. So if, let's say, the P/E ratio of the listed company is 13, the P/E ratio of the unlisted would be adjusted downwards. So we will deduct 25%, the remaining, or multiply by 75% to get the P/E ratio of the unquoted, right? So that of the listed companies' P/E ratio is higher than the P/E ratio of the unquoted company, for the unquoted what? Company. All right, so let's look at some of the advantages. Those are some of the advantages. So they are based on similar listed what companies. They are based on similar listed companies. And then they are widely used and accepted. The P/E ratio, widely used and accepted. P/E ratio is widely used and accepted, right? All right, what are some of the disadvantages? What are some of the disadvantages? Disadvantages that we can talk of. What are some of them? All right, so we can talk of it relies on a proxy P/E ratio, right? And then uses historical or historic earnings. Historic earnings. Then the last one that we can talk of under the approaches is the class based. Okay, before that, let's look at the earnings yield. So we've talked about the P ratio. Let's look at the earnings yield as well. So the earnings yield method under the income earnings approach, earnings yield method. So with the earnings yield, it's basically the inverse of the P/E ratio, right? So this is simply the inverse. The inverse of the what? Of the P/E ratio. Right? So with the P/E ratio, what's the formula? Formula is what? P/E ratio is equal to the price earnings over what? Earnings per share. So if you are saying this is the inverse, if you are saying the earnings yield is the inverse, then what will be the earnings yield? The earnings yield will be what? EPS over what? Over the NPS, right? So you're saying that it is the inverse of the P/E ratio, inverse of the P/E ratio, inverse of the P/E ratio. So how do we get the value of a share or the value per share? The value per share is basically the EPS over the earnings yield. Right? And I believe I can also do it EPS times 1 over the earnings yield. I can also do it that way, right? Then what is the value of the company as a whole? Value of the company as a whole. So the value of the company as a whole is what? Is the total, right? Total earnings over what? Over the earnings yield. Total earnings over the earnings what? Over the earnings yield. And I believe I can do total earnings like the way I did for this. I can also do it that way, right? 1 times. It's basically the same thing. All right. So that is for the value of the company, right? Value of the company. And maybe in some instances where they say that there's good in the earnings, then we can also look at the formula. If there is good with maybe a particular question, there is good, it grows, then the value of the company becomes so we can have it as the earnings 1 plus G, right? When there is growth, and then the earnings yield minus G. The earnings yield minus what? G. So then we are going to use this formula. We're going to use this formula. All right. So now we can proceed with the last approach. The last approach, which is the what? Which is the cash flow based. The cash flow based. The cash flow based. The cash flow based. The cash flow based method, right? So with the cash flow based method, we can talk of the dividend. So this involves cash flows, right? The cash flows of the company. So the dividend group, the dividend valuation method, right? I believe from our previous meetings or previous lectures, we talked about the dividend valuation method. So the dividend valuation model, DVM, the DVM. What else? Then we can talk of the discounted cash flow basis. What else? Then we can talk of what? Is it only 2? Yeah. All right. So we'll talk about these 2. All right. So let's look at the dividend valuation. The dividend valuation module. So how is the dividend valuation model like? So this value the company, the valuation of the company using this model is basically the present value of the expected or future dividend, right? It's basically looking at the present value of the future dividend. and which are discounted at the rate, right? At the shareholders' required rate of return. So we talked about the price being the D0 all over what? The required rate of return, right? The discount rate. And we also talked about the P0 being also the D0 over 1 plus G all over what? When there is growth. Is it R minus G? So that is R minus what? Minus G. R minus what? G. So you can see that this same thing is applying to, look at this, it's applying to the earnings yield, right? Minus G, right? This same assumption is applying to the earnings yield, so minus G, right? Okay. So what else? What else? Okay, so let's look at some of the advantages. It includes what? Good. What else? It links to shareholder wealth. All right, and many more. Disadvantages. Disadvantages. All right, so not all companies pay dividend, right? Not all companies pay what? Dividends. A loss-making company or maybe a new company may not be paying dividend, right? So maybe a loss-making company or a new company may not be paying what? Dividend, right? So that is an advantage. And then it assumes a constant growth. It assumes a constant what? Growth, not differential growth, right? No differential growth, but then a constant growth. You can see that the growth is constant and not a differential growth. All right, so let's quickly move on to the second one, which is the discounted cash flows. The discounted cash flows. The discounted cash flows. Discounted cash flows. Discounted cash flow basis. So what is that about? That is looking at the present value So how do we get the maximum value? The maximum value of the business, or the value of the business basically. Maximum value of the business. So how do you get the value of the business? That is the present value discounted. So you are discounting the present values of the future cash flows. Present value of the future cash flows. And then we use a discount rate reflecting the systematic rates of the flows. Right? We use a discount rate which is reflecting the risk All right. So now, I think we've done enough. So we can just look at the questions. Let's quickly look at the questions. Okay. Someone should quickly read the question. All right, so who is reading for us? Someone should read the question. So someone should read for us. Francisca, read for us.
The following is an abridged version of the statement of financial position of 𝒔𝒊𝒏𝒆𝒔𝒔, an unquoted company as at 30th April X6. Non-current assets carrying value $450,000. Net current assets $100,000. $1 ordinary shares 200,000. Reserves 250,000. 6% loan notes Z1 100,000. You ascertain that loan notes are redeemable at a premium of 2% current market value of freehold property, exceeds carrying value by $30,000. All assets other than property are estimated to be realizable at their carrying value. Calculate the value of an 80% holding of ordinary shares on an asset basis.
All right, so on an what? Asset basis. So we are using the asset-based method. So you always read the requirement to know the method to be used, right? So here is saying on an asset basis. So you are going to use the what? The asset-based method. So using the asset-based method, how do we value a business? So the valuation of a business, the value of the company, using the asset-based value of the company is what? The total assets. Total assets minus what? Minus the total liabilities. Minus the total what? Liabilities. Right? Total liabilities. So from this question, what are the total assets? We know that the total assets comprise of what? It's made up of the non-current assets plus what? The net current assets. Net current what? Assets. How do we get a net current asset? Net current asset is basically current asset minus current liabilities. I believe you know that net current asset is the same as a working capital, right? Working capital. So that is the current assets minus current liabilities, right? All of this minus what? Minus the total asset. So here, what is the total? Sorry, total liabilities. So we have represented by a 1 cedi ordinary share. This is not a liability. Reserve is not a liability. 6% loan note is a liability. So minus what? The loan note. Long-term what? Loan note. Long-term what? Loan note. Or long-term debt. And it's a long-term debt, right? Okay. And they are saying that we should what? We should calculate the value of the company, right? We should calculate the value of the company. All right. So, what is the non-current asset? So let's just have it. Non-current asset. Non-current asset is how much? The carrying amount. Let's look at the additional information. Loan notes are redeemable at a premium 2%. Current market value of freehold property exceeds current value by what? 30,000 of freehold property. Do you know freehold property is also a non-current asset? So it means that this non-current asset has freehold property embedded in it, and they are saying that this is the carrying amount. These are the book values, right? These are the book values, and they are saying that it exceeds the carrying value by 30,000, right? Additional information here, it gives the market value, but it tells more about the book value. So that gives out the market value today. Okay, then all assets other than property are estimated to be realized at their current value. All assets other than property are estimated to be realized at their current value. It means that all the assets we use the book values, right? All the assets that we are seeing, we are going to use the book values or the current value. The current value is the book value that we are seeing here, book value, right? Except property. So it means with the property, we are going to use the what? The market value. The property, we are going to use the what? Market value. So the non-current asset was 450,000. So 450,000. And they are saying that all other assets, apart from the property, we use the book value. It means with the property, which is the freehold property, exceeds carrying amount by 30,000, right? By 30,000. So you are going to add that one to get the market value. This alone is the book value. So we need to add the 30,000 because you are saying that it exceeds, right? It exceeds the current value by 30,000, right? So it means we have undervalued the freehold property. We have undervalued. So we have to add it back. So add undervalue freehold property. So how much is it? 30,000 by 30,000. Then now we come to the net current assets. How much is it? 100,000. It says that all assets other than property are estimated to be realized at their carrying amount. Yes, so it means this is also realized at the carrying amount as we are seeing. So it means net current asset. Net current asset. How much is the net current asset? 100,000. Right. So how much is the total?
580,000.
580,000. All right. Then
Please
what do we do now?
explain the undervalued freehold property.
Okay. So this statement here is saying that all assets, these are the assets, right? Non-current assets and then net current assets. These are the assets. Other than all other assets, other than property, are estimated to be realized at their carrying amount. These are the carrying amount of the items. These are the carrying amount. 450,000 is the carrying amount. 100,000 is the carrying amount. This one to 200, 250, 100. These are the carrying amount. And they are saying that all other assets are using the carrying amount except property, which is using its market value, right? The market value is the realizable value, right? Is the realizable value. When I was giving the types under the net asset base, I said book value, realizable value, and the replacement cost, right? So the realizable value is the same as the market value, right? And then the replacement is revaluation, right? Revaluation, or the revaluation method, right? So here they are saying that all of them are using these values that we are seeing, all the assets. So they are talking about just these two assets. Well, anyway, these two assets, they are using their carrying amount, except property, which is using the market value, right? Except what? Property estimated to be realizable, right? Except property. So look at the property. They are saying that current market value of freehold. I think there's a full stop here. Loan notes are redeemable at a premium of 2%. Full stop. Current market value of freehold property exceeds carrying amount by 30,000. It means that if you want to get the market value, how much is the market value? The market value amount exceeds the current value that we are seeing. So it means the market value amount is 480, which is the 450 plus 30,000, giving us the 480. And that exceeds the current value by 30,000, right? If the market value, let me also say this, if the market value is there and the book value is there, and if the market value then the book value is there, they would give you information to which of them you are to use, right? To which of them that you are going to use. So if they are saying that with this one, use market value, then use the market value. If they don't say anything, then use your book value, right? Xavier, are you okay? Hey, is she here? Xavier.
So please, does it mean the 580,000 is the market value of the freehold property?
No. Freehold property. Do you know freehold property is a non-current asset? Do you know property is
Yes,
a non-current?
please.
And they are telling you that this non-current asset, it includes, so non-current asset, you can have building, land and building, property, what else, and what have you, right? So they are saying that, and of course, the property is embedded in the non-current asset. The property is embedded in it. And they are telling you that what's the name? They said the market value of the freehold property exceeds the current value by 30,000. They are giving you the market value here. And they say the market value exceeds the current amount by 30,000, right? By 30,000. So let's even assume the entire non-current asset is is for property. This non-current asset that let's assume that it's all for property. So this is the current value for property, 450,000 property. And the market value today, we have book value and market value. Do you know we have book value? And the book value is the current value that we are seeing in the financial statement. And the market value is the realizable value today, right? If you want to sell it today, right? That's the realizable value, the current value. And they are saying that it exceeded by 30,000. It means that if you want the total market value, it is the 450 plus 30,000. Bro, academic correction. Why academic correction? Oh, academic writing too.
That's why.
And you know, it's exceeds current value by, what's a buy and two? Buy and two. Buy means that the difference, you add it back. Buy. So it means in total, current market value is what? 450 plus 450,000 plus what? Plus 30,000. And that will give you 480. The current market value is actually 480. And our current value near 450. The Buafuna I can say, if this is 480 and this is 450, then I can say that the current market value exceeds the current value by 30,000. That is what they are telling you. Do you get it now?
Yes, please.
All right. Thank you very much for getting it. All right. So now, then we deduct our loan debt, right? The debt is 6% loan note. Less the 6% loan note. What did they say about the loan note? They gave additional information on the loan note. They said the loan notes are redeemable at a premium of what? Of 2%. This is a premium, right? So it means the loan note will be 100, this is 100,000, and it will be redeemed at a premium. So it's your premium account. So the loan note 2% means 0.02, right? So I'm growing this 100% by the 0.02, and that is giving me how much?
$2,000.
That's giving me how much? 100,000 times 1.02.
Please, why is it not 0.02?
If I multiply by 0.02, I'll get just the premium, and then I'll add the premium to the 100,000. In order to avoid all these steps, I'm just doing it at once. So I'm multiplying it. It's like growing 10 into bracket 1 plus G. You are growing it. So if you do it this, you are going to get the total amount plus the growth, right? So the
102,000.
100 and what?
102,000.
All right. So this is the only debt, long-term debt that we have. So what are we getting? Let's hurry up.
178,000.
Okay. So how much? Sylvia, what is the figure?
478,000.
I should be leaving the figure for you to go and compute when you get home. Yeah, I think that one will work best. All right. Now, they calculate the value of an 80% holding ordinary shares. So value of 80%. So value of 80% is equal to the 80% of the 478,000. What do we have?
$382,400.
382,400.
For
All right. So that is it for the what's the name? The first question. Now income and earning base. Let's do the PE ratio and then the earnings yield. So read the question.
You are given the following information regarding Nanning Co., an unquoted company. A. Issued ordinary share capital is 400,000, 25-cent shares. B. Extract from the statement of profit or loss for the year ended 31st July 20x4. Profit before taxation 260,000. Less corporation tax 120,000. Profit after taxation 140,000. Less preference dividend 20,000. Ordinary dividend 36,000. Retained profit for the year 84,000. C. The PE ratio applicable to a similar type of business suitable for an unquoted company is 12.5. You are required to value 200,000 shares in Nanning Co. on a PE ratio basis.
All right. So they are asking of the PE ratio basis, right? We are using the PE ratio basis. So what is the formula for the PE ratio? The PE ratio is equal to the market share price all over the world, the earnings per share, right? The earnings per share. All right. So how do we get the market share price? The market share price is just cross multiply, right? That is the PE ratio times the earnings per share, right? And the earnings per share. All right. So then how do we get our earnings per share? Earnings per share is the total earnings. Is the total earnings over what? The number of ordinary shares, right? Over the total, let me see, the total number of ordinary shares. So how do we get the total earnings? How do we get the total earnings? Total earnings is equal to, now let's go. So earnings is equal to profit after tax minus the preference share dividend. Preference dividend, right? Preference share dividend because we want the earnings that is attributable to the equity shareholders. We want the earnings that is for the equity shareholders. So what do? We deduct the preference dividend. I believe you remember this from the earnings per share that we did in financial reporting. Okay. So what then is our profit after tax? Profit before tax 260,000 less corporation tax 120,000. Profit after tax is 140,000. So 140,000 minus preference share dividend. So preference dividend is what? $20. So you are going to deduct $20. What is our profit after tax? Sorry, what is our total earnings? So that is 120,000. 120,000. Now, having this 120,000, what else? We can now find our EPS, earnings per share, which is what? Is it the 120,000 all over the ordinary shares? How do we get the ordinary shares? I think it has been given here, right? Issued ordinary share of 400,000 25-cent shares. Assuming they don't even state it here. Sometimes they will not even give it to you straightforward. Let's look at the first example. Look at it. It's not giving us ordinary share. But if you want to get the ordinary share, we know that it is the ordinary share. It is quoted at $1 per share. And we have been given a value of 200. So we just 200,000 divided by 1 cedi. Then that will give us the 200,000 shares. Assuming this value is 0.5, we'll see the 200,000 over 0.5, right, to get the ordinary, right? But we know that the value is equal to what? The ordinary shares times the price per share. So if they don't give you the ordinary shares straightforward, then you have to do this to get the ordinary shares. So here, the ordinary shares is 200. That is the 200,000 value divided by the $1 or $1, right? Okay. So that is it. So here they've given us the ordinary shares. How much is the ordinary share? It is 400,000. So what is our earnings per share? Earnings per share is how much?
0.3.
That is 0.3. All right. Can we now get our market price per share? PS. That is the PE ratio times the earnings per share. What is the PE ratio? What is the PE ratio? What is it? The PE ratio applicable to a similar business is 12.5. So 12.5 times 0.3. What do you have?
3.75.
That will be 3.75 per share. $3.75 per share, right? Okay. What else? Then now what do? We are required to find the 200,000 shares. Oh, okay. So now they've given us, they want us the value for 200,000 shares. We know the price per share. So market value for 200,000 shares. That will be how much? That will be 3.75 times the 200,000 shares. So how much are we getting?
750,000.
All right, so that is for the PE ratio. That is for the PE ratio. All right, so the next one will be earnings yield. All right, to read the earnings yield.
Company A has earnings of $300,000, growing at 3% per year. A similar listed company has an earnings yield of 12.5%. Company B has earnings of $420,500. A similar listed company has a PE ratio of 7. Estimate the value of each company.
All right, so from the information given, you can see that growing 3%, a similar listed company has an earnings yield. This should inform you that we are going to use the earnings yield formula, right? You are going to use the earnings yield formula. So this heading that I've written here, you not see it as part of the question. It is because it's a document, that is why you are saying it there. But I'm teaching you that assuming you don't see the earnings yield here, it is the earnings yield that is giving you here would inform you that you are going to use the earnings yield formula. All right, if the question does not go straight to the point. See here, it said estimate the value of each company. From the information given, you should know that, oh, this one I can use the earnings yield. Let me use the earnings yield formula. All right, and this one is at a growing rate. So what formula did I give for the earnings yield? Yes, what formula did I give?
Earnings per share divided by price per share.
The earnings yield. You then also see the price per share is the earnings per share. I think the inverse of the what? Of the P ratio, right? Did I not say the inverse of the P ratio? Hello, did I say that?
Yes, you did.
Alright, so if it's the inverse, then P ratio, we know that it is MPS, price over the earnings. So if we want the earnings yield, is it not the EPS over the MPS? And if you want the MPS, we just interchange, right? Alright, so earnings yield is equal to earnings per share over the MPS. So what is our MPS? MPS is earnings per share over the earnings yield, right? Over the earnings yield. And we are saying that this is per share, but from this question, I give you two formulas, and I give another one when it is growing. When it is growing, then what will be the total market value? The total market value would then be what? Will be the total earnings total earnings 1 plus G all over the earnings yield minus the growth, right? Earnings yield minus the growth. So what then? Let's come to company. We have been given two companies. So company A, I've been given two companies. So let's start with company A. So with company A, they said we're having, how do we get a total market value? Total market value is what? Is 300. The earnings is 300. Total earnings is 300. And that is growing at 1 plus G. What is the growing rate? 3%. 0.03. 0.03. So here, this is the first, I wrote 1.02 when I was doing the, so this one it can be 1.03. It's the same thing. 1.03. 1 plus 0.03 is 1.03. All right. So all divided by what? Earnings yield. What is the earnings yield? 12.5% minus what? The growth rate, which is 3%. So what do we have?
$3,252,632.
3 million.
252,000.
Mm-hmm.
632.
Okay. All right. So that's for company E. Company B. Company B is what? Adjusted what? The company B has earnings of 420,500. A similar listed company has a P ratio of what? 7%, right? So company B has 420. A similar company which is listed, right? A similar company which is listed is what? Is having a P ratio of what? 7%. So we have to adjust this P ratio, right? We have to adjust this P ratio. So how do you adjust it? Adjust it downwards. We adjust it downwards, right? So adjusted P ratio. So we said usually the P ratio of the listed is higher than that of the unlisted. So the adjusted P ratio would be what? I say 75%. Someone can also use 70%. So 75% of the, how much is it? 7. That would be the P ratio for the unlisted one. So how much is that?
Please, why is it either 75% or 70%?
Yes, so the unlisted company, they are not listed, right? So PE ratio, which is the price earning ratio for the listed company. The listed company is listed on the stock exchange, and for them, they have a higher PE ratio. So you cannot say that the listed company and the non-listed company have the same PE ratio, the price earning what ratio, because the PE ratio is highly, for the listed company, is highly regulated on the stock exchange. So the pricing for that share would be higher than that of the price of a company that is not listed. You get it? You get it?
Yes, please. But I'm saying that, so does it mean anytime we should use 75%? Because it wasn't in the question that 75%.
Yes, that is a rule. 75%. Some people also use 70%. You can use 70% or 75%, right? Just tell the examiner that you are adjusting it downwards. The adjustment is downwards, but it should be 75 or 70, depending on what you have. So, depending in your slides, I have not checked, so I don't know what you have in the slides. If I've checked, I would have used what is in the slides. So when you go back, you can just go and see if you can see the adjusted PE ratio under the business valuation and see the percentage that they gave. But it should be more than 50%. It should be more than 50%. So 75% or 70. Yeah. All right. So what do we have?
$5.25.
5.25. Right. So this 5.25. What then is the total market value, right? What then is the total market value? The total market value is what? Is the PE ratio, is the adjusted PE ratio. Adjusted PE ratio. Adjusted PE ratio times what? And the earnings. Times the earnings. So how much are we getting? So the adjusted is 5.25 times the earnings is how much?
4,500.
Yes, what do you have?
Two million
Mm-hmm.
207,625.
625. So that is that. What else? Then we can move on to the next question. Cash flow based. And the cash flow based. Hurry up. The reader should read, please.
A company has the following financial information available. Share capital in issue, 4 million ordinary shares at a nominal value of 50 cents. Current dividend per share, just paid, 24 cents. Dividend 4 years ago, 15.25 cents. Current equity beta, 0.8. You also have the following market information. Current market return, 15%. Risk-free rate, 8%. Find the market capitalization of the company.
Find the what? Market capitalization of what? Of the company. All right. All right. So what is the price? You have the price per share for the dividend valuation model, the DVM model, right? How do you get a dividend? So, given the available information, it means the dividend. Is there any growth rate? So there should be there's a constant growth. Okay, so um the D0 is about 1 plus G all over the required rate minus G, right? So how do we get the G? We use the formula to find the G. Find the constant, use the constant growth rate, right? So let's find the constant growth rate. How do we get a growth rate? I give a formula for finding the growth rate. So I said the end of the current dividend all over the past dividend, everything minus 1, right? Remember this formula? Right, so how then do we get the number? What is our N? What is our N? Hello, a company has the following financial information. Share capital in issue is 4 million, right? Ordinary shares at a nominal value of 50 cents. Current dividend per share just paid is what? Is 24 cents, right? So 24 cents is 0.24. Dividend 4 years ago. So the N is what? 4. Dividend 4 years ago is N is 4. And then what is our current dividend? Current dividend just paid. So 0.24 all over the past dividend. Dividend 4 years ago is 15.25 cents. So that will be 0.1525. Everything minus 1. Then we are going to get our G. What is our G?
0.870.
0.870. All right. So that is our growth rate, right? That is our growth rate. So now, what else do we find? We are going to find our find the required. What do we want? We want the. We've not been given the J. Were we given the required rate, current market return, risk-free? So we are not given the required rate to, right? The cost of equity. So we are going to use the CAPM. We can use the CAPM to find the cost of equity. We can use the CAPM to find the cost of what? Equity. So what is our CAPM? CAPM is what? The risk-free to RE using the CAPM. RE is equal to what? The risk-free plus what? The beta. Plus the beta, and then the market return minus the what? The risk-free. And this is the market premium, right? RM minus RF is the market premium. So what is our RE? RE is giving us, the risk-free is giving us what? 8% plus the beta. Beta was given us was 0.8. Then risk-free market return. The market return is 15% minus the risk-free. Risk-free is what? 8%. Right. So what is our the required? Is someone speaking?
The G, you have to confirm it. I think it is 0.12.
Is someone speaking?
Yeah. The G, the growth rate, I think it is 0.12. So let us confirm it.
Is there anything the growth rate is 0.12?
Yeah.
Very fine. Any third person?
Yes, please. That's what I also got. So I thought the mistake was for me.
What did you get?
0.12.
So that's 0.12, and that is 12%. Okay. What of the required rates?
$0.136.
0.136. 0.136. So that's 13.6%. All right. Now we can go and find our what? We can insert them here. So D0 is how much? D0 is today. How much are we getting for that? 0.24 today. 1 plus G. G is 12%. 12%. 12%. So 0.12. All over the rate. How much did we get for the rate? 13.6. 0.136. So 0.136 minus the growth is what? 0.12. So how much are we getting?
16.8.
15.8. All right. So that is our what? Our price, market price per share. Right. That is our market price per share. All right. So now how do we get the total market capitalization? So the total market capitalization is equal to what? Is the 4 million shares times what? That's 15.8.
Please, it's 16.8.
Yeah, so multiply it by the 4 million.
I'm saying it's 16, not 15. $67,200,000.
67,200,000. All right. So that's the market capitalization. That's the market capitalization. And the level of discounted. All right. So we will not be able to do the measures and acquisition. Measures and acquisition. Measures and acquisition. So let's look at the last one and then call it a night. Let's look at the last one and then call it a night. The discounted cash flow method.
A company's current revenues and costs are as follows. Sales, $200 million. Cost of sales, $110 million. Distribution and administrative expenses are $20 million. Tax allowable depreciation, $40 million and annual capital spending is $50 million. Corporation tax is 30%. The current value of debt is $17 million. The WACC is 14.4%. Inflation is 4%. These cash flows are expected to continue every year for the foreseeable future. Calculate the value of equity.
All right. So they've given us the relevant information, and they are asking us to calculate the value of equity, right? All right. So we would have to get the cash flow. We would have to get the cash flow, right? All right. So what is the sales? We have to get the net cash flow. So what do we have? What is the sales given? The revenue. Revenue is how much? 200 million. Then we less cost of sales. What is the cost of sales? The cost of the sale is 110. What else? Any other cost or expenditure? Distribution and administrative expenditures. So distribution and admin expenses is 20. What else? Tax allowable or depreciation. Tax allowable or depreciation. All right, so let's get our operating profits. Let's get our operating profits. Then we look at the tax on it. What is the operating profit? The operating profit or the operating cash flow.
$30 million.
Sorry?
30 million.
30. Is it 30? 200 minus 110. 70. So then what is our tax? So there's a tax of how much? Corporation tax of 30%. What is the tax?
$21.
And then they are saying that what tax savings. So there will be a tax savings, right? There's a tax allowable depreciation. That is a capital allowance, right? The capital allowance. So how do you get the tax savings on the capital allowance? So there's a tax savings on capital allowance. The capital allowance is $40. So 30% on that 40 is how much?
12.
All right. So that tax saving would be a positive figure. What's the benefit I get? What else? They're saying that annual capital spending of about 50 million. So that is a cost. Annual capital spending. What do you have as the net cash flow?
$11 million. Please, I had 11.
Okay, so 11 is the cash flow, right? Net cash flow. So what do we do to the net cash flow? We have to discount the net cash flow into the present value, right? So we have to use the rate, the discount rate, to discount it into the present value. What is the discount rate? What is the discount rate? We're not giving discount rate. All right. We're giving inflation of 4%. So let's compute our discount rate. Let's find our discount rate. So there's a formula for finding the discount rate. There's a formula for finding the discount rate. 1 plus n is equal to 1 plus r multiplying 1 plus h, right? Multiplying 1 plus h, where h is the inflation and the r is the rate that you are looking for. And then what of the n? What is the n? Is it nominal?
The nominal.
Yes, the nominal, right? R the subject, divide both sides by 1 plus h, 1 plus h. So 1 plus r is equal to what? It's equal to 1 plus n all over 1 plus h, right? What do you have? Now making r the subject, what do we do? Making r the subject, what do we do? So that will be, the 1 will cross. So we have r is equal to 1 plus n all over 1 plus h minus 1, right? Minus 1. What is our r? Our r is what? 1 plus. What is our n? N is the nominal. So here the nominal is the WACC, the weighted average rate, which is 14.4% all over 1 plus the h. H is the inflation, which is 4%. So let's find the real interest rate. Let's find the real interest rate. Minus 1, right?
I had 0.1 or 10%.
0.1. So that's basically 10%, right?
Yes, please.
10%. So the real interest rate is 10%. So now we have to discount the cash flow given into the using the discount rate. So what will be the discounted value? Is equal to the cash flow times the discount rate. Do you know why I use 1 over R? Who can tell me why I use 1 over R? We know the discount rate is 1 plus R, right? Right? This is a discount factor. But here I'm using 1 over R. Who can tell me why?
Please, I want to try. Is it because it's
Okay.
perpetuity?
Perpetuity. Did they say perpetuity?
I don't know. I'll just try.
But I mean, where did you see the perpetuity from? No one knows here. So where did you see? Because I'm saying I don't know. Who goes see that? Where did you see perpetuity from?
Oh no, I've not seen any perpetuity. I'm just see the discount value. Normally, when you want to find the present value of let's say a
Perpetuity.
perpetuity, that's
Yes.
how I
And then,
find it.
yes, and there is perpetuity in the question. Look at this statement. These cash flows are expected to continue every year for the foreseeable future. That is forever,
Oh,
right?
oh, okay.
That is why I'm using the perpetuity, which is the A over R. Do you remember?
Yes, please.
That's why I'm using the perpetuity.
Oh, okay.
So that's why I'm using the 1 over R. So that would be what? 11 times 1 over rating is 10%, 0.10. So what do you have?
110.
So the discounted value will be 110 what? Clear. What else? The question is here to find what? Calculate the value of equity. What is the formula for equity? Equity is it not the same as net asset? Anna,
Yes.
is it not the same as asset minus liability? Basic accounting is equal to equity. Anna,
Hmm.
all right. So then asset equity is equal to asset minus equity. Sorry, minus liability. So what then is the asset? The asset is what you've gotten. 1 this will be the asset here. Any liability, what is the liability? Do you have any liability? The current value of 17 million. What do we have? The equity will be, how much is it? 90 something.
93.
93 million. All right, so that is the value of the equity. On that note, we would pause here for today, and the next time we have to quickly finish the measures and acquisition and see if we can do something else. All right. Thank you very much for coming. Is there any question?